Okay, we're going to be tackling money management. And what topics are we going to be covering in this module? Is system accuracy important? I don't believe system accuracy is all that important. I believe that a relatively low accuracy rate could still be profitable. And I'll give you an example of that in this specific module. But I want you to understand that a lot of new traders, developing traders, and traders that have been unprofitable for a while tend to believe that it's their system and the lack of high accuracy that is what prevents them from seeing a positive outcome. And that's not it. It really isn't it. It's the losses that erode by the means of drawdown. Every losing trader, every busted account starts with a single loss, and it compounds. And what generally happens is traders will lose their mind because they are not disciplined. They don't have a procedure or protocol in place to deal with a losing trade or a series of losing trades. So I think that system accuracy is kind of like a misnomer. Certainly, there's nothing wrong with an accuracy that's high, but it also goes along with just because it's been accurate a certain number of times in the past is in no way, shape, or form a promise or guarantee that that system is going to deliver the same going forward. It could fall apart. It could have, you know, Lord knows how many losing trades. I've had systems and developed all kinds of methods over my last 25 years, and some of them looked great on paper, but as soon as you try to plug them into live markets and walk forward with them, they didn't hold up. And they were all based on TradeStation systems that I was trying to create back in the 90s with the bond and S&P market. But if you are on the fence about having the dependency on system accuracy or finding it terribly important, I don't think it's something that you should lose sleep over. All right, so how much equity should be risked? Well, I don't believe there's a cookie cutter approach to this. Everyone, and I've done this in the past, uses a standard 2% as a maximum. And truth be told, when I'm trading, I've risked as much as 3.5%. And sometimes when I was really being a cowboy, I was risking as much as 5 and 7%. And they were more or less just working towards accelerated growth and also testing what I was able to do as a trader. But generally, my risk appetite is about 1%, 1.5%. If I really want to push it, everything really, really good, I'll go as high as 3%. Generally, it's about as high as I'll go. So I think the question really is a matter of personal choice and preference. What I'm willing to assume as a risk percent may not be as welcome as a percentage for risk for some of you. For some of you, 1% may be extremely too high. Uh, for others, it may not be high enough. So everyone's going to have their version or comfort zone for risk. And I don't want to be the type of mentor that tells you this is how much you should risk, because I teach in a demo account. So I think that it's reasonable to assume 1% or less as a risk parameter for your demo account. But I would never tell you what you should do with your live account, because it's going to be all dependent on what you're willing to assume as risk, what you can tolerate. Some of you, if you put a trade on, even in a demo account, you lose your mind over it because you can't deal with the uncertainty, and there's really no money on a line. It's just that you're so keyed up about being right, and that's going to translate into problems with your money management, because if you need to be right, you're not going to trade profitably. Should traders always push their edge? I see this a lot online, and it's one that gets under my skin because, again, it gets back to the first question. Is system accuracy important? I don't believe that a trader should always get in there and push their edge, because no matter how good you are, how good your system is, it's going to incur a loss. And you don't know if it's going to be a single loss or it's going to be a series of losses. And it could be a string of losses that you were not expecting. And at some point, you're going to need to pull the plug and say, okay, I can't trade anymore this day or this week or even this month if it's really bad. The problem with pushing your edge is you're always going to have a reason or excuse to do so. So I have, over the years, built in kind of like um, a breaker for my activity and thresholds, because if I do not see a turnaround in my losing trades or a string of losses, I can very easily wipe out an account just as well as anyone else can. So it has to be some kind of a measure in place that helps me throttle back when I'm active and when I'm going to resume again. So while I'm not going to be talking about that so much, I do talk about that in the mentorship, and I do go into greater detail with money management and specifics with trading plans that will be taught in 2018 for the members that have gone through the entire core content. But for this teaching, I want you to focus on the importance of sound money management and risk control. What causes traders to blow out? I personally believe it's their inability to weather a series of losses. Now, anyone can take a loss or two, and it doesn't really make anyone go crazy about it. But what happens is if there's a back-to-back consecutive 5, 6, 7, maybe even 10 losing trades in a row, as a developing trader, that's normal. If you're trying to avoid that, you're actually hurting and stunting your growth as a developing trader. So you want to be able to experience that phenomenon of being convinced almost that the trade's going to work out, but then see it not come to fruition, and then having to wrestle with that, because that internal dialogue that takes place in your mind, the emotions that well up after that, you need to wrangle them, because they're going to always be there as a trader. Now, you either can make them allies or you can view them as enemies. Okay, they're always going to be plaguing your results, and certainly plaguing your clarity or perspective on the marketplace. And you don't want to give them that power. Okay, fear and greed, they can be dealt with, but it has to be with a process and a clear, developed plan. So every trader blows their account with a series of losing trades, but it starts with one losing trade. It always starts with one. And what goes on between your ears, okay, inside your mind, is what manifests in your account. Now, if you take the loss and you think to yourself, well, that didn't work out, next, and that's your mentality, but you don't think, next, I'm going to get it back right now, and I'm going to over leverage and go through the martingale procedure of, you just took a loss of $100, now you're going to risk $200, and then you're going to risk $400, then you're going to risk $800. That doesn't work. Eventually, you're busted. So I've looked at all kinds of money management approaches. I've studied Ralph Ince and Ryan Jones' work, which I think is exceptional work. It's really hard to read. It's rather dry, but if you can tolerate those types of things, it really stimulates the ideas that are potentially there for gaming theory and the Kelly principle and optimal F. So if we can see there are measures of controlling risk and money management approaches in gaming, okay, and for instance, like blackjack or roulette, which I admittedly have never been to a casino to play either one of those, but I did study the games and I did study gaming theory, and I've always been fascinated with the World Poker Championships, and I've always been fascinated to see the same faces generally make it to the last table or so. And I don't believe it's the cards that they're winning with. I believe it's they know when to push their money and when to cut it back. And if you watch them play, I watch that part of it. I don't watch what they're doing with their hands, because they have no idea what the next cards are going to be. But they do know how much they're going to risk from the pot perspective, if you will. How much are they going to ante up? And I've always been fascinated with that. So I've kind of like used those ideas from professional gamblers, okay, and used some of their approaches and applied it to a money management strategy, which I think you'll find rather interesting. In this teaching, the takeaway is I'm going to teach you how to flatline equity drawdown. All right, how to flatline equity drawdown. All right, so when we start trading, obviously, Uh, we're all excited about what we're going to potentially see as a result. You open your demo account up and you want to start seeing increase or that jump up in the demo equity to build your confidence to eventually at some point in the future when you make the decision to do it, if you ever do it, to trade with live funds, you'll be able to have the experience to look back on as a demo trader and see that you've done certain things over consistent length of time where it warrants, by your own decision and your own timing, you elect to go with live fund trading. I never tell anybody when to do that, and I'm certainly not advocating to use live funds with the information I'm sharing here. This is just informational purposes only, and everything I teach, it should be viewed in light of a demo account application only. But if you're practicing with a demo account, how do we practice money management approaches? Well, we're going to go into that now. Obviously, as I mentioned already, every trader is going to have to encounter a losing trade. As a new trader, especially if you start with live funds, you're trying to avoid this like the plague. And generally, it's a good idea to try not to lose money, but you can't avoid it. It's going to happen. It's an absolute. You're going to run into a brick wall, and money will be withdrawn from your account, whether demo or eventually, if you ever decide to do it, live funds will come out of your account. It's guaranteed. You need to be able to have a frame of mind and a procedure on how you're going to encounter and engage and overcome that obstacle. Equally so, every trader will experience a series of losing trades. Now, this is where that wave of emotion comes in, and you feel regretful. You wish you wouldn't have done certain things, and then certain emotions will trigger a response that may result in anger. You may lash out at your computer, lash out at your friends and coworkers, or your family, your spouse, your children, your dog. Don't do that. The procedures that you need to have in place is what you're going to do to, number one, control the bleeding. Okay, you have to slow the bleeding, whether it be a live account or a demo account. So stop losing money, slow it down, and then eventually look to mitigate it. But you can't come back from massive losses if you don't first identify what you're doing wrong and stop doing that very thing, which is over leveraging or keeping risk at a constant. Now, professional money management concepts are used by the informed speculators to help keep their equity base smoothed. All right, so we have here a hypothetical random result of 20 trades. And these are not actual trades. They're just hypothetical for the purpose of giving an illustration here. All of the illustrations here are all hypothetical, but they will give us a kind of like a perspective to consider. And it's important for you to take these as general rules of thumb, go through using a demo account, using these applications, and you see what you get from it in terms of experience. But the outcome with these 20 trades here from this particular trader, we'll call it Trader A. The trader starts with a $5,000 account, and using a 3-to-1 reward to risk model, they're willing to hold on to a trade 3 times what they're willing to take as an initial risk or stop loss. And they're using an aggressive start. That means they're going right in using 2% risk right from their start. And they show no regard for future losing streaks. The typical equity, and this is what you may have encountered with your demo account when you first started trading, you start seeing a little bit of a drawdown, and all of a sudden you get lucky with something and it starts to pop up, and the equity line starts to increase, and this always feels good. And then all of a sudden it starts to drop down in here. And this part of the movement in your equity line, this is what causes the freak out movement, because when it's a little bit of a drawdown, it's not that big of a deal, but when it starts to be consistently pointing lower, our minds don't like to see that. Okay, we like to see it increasing. Okay, and what will happen is you're going to want to do things more frequently, trade with larger leverage, and do more than you should. Trade at times when you shouldn't be trading. There's the less active times in a 24-hour time of the market day. You don't want to be doing those types of things. But invariably, this line, okay, is the biggest indicator, okay, that makes traders do more things than any other. And it's not an oscillator, even though it does oscillate. Many times it just goes to oversold with most traders in terms of their equity dropping. But I think that this line, or this cumulative line of our equity, drives more traders to do the wrong thing than anything else we could put on our chart. And I don't believe that indicators should be used on our charts, but I think everything that you would put on your chart as an oscillator is safer than worrying about this line. Okay, everyone that has the ability to see what their equity line is, or equity curve, as a developing trader, this is the least important thing. Okay, there's so many rules that you gotta apply before you would ever get any kind of information or feedback loop from this information, because you don't know what you're doing. There's no system or procedure or progress to weigh. You're just starting. So the worst thing you can do is look at your equity curve and base that on whether or not you're doing well or not, because initially you could have luck. And many times, and you've probably done this, opened a demo account and done a couple different things, over leveraging, and you think that this was a skill that caused that, and when it was just a coincidence. And coincidences sometimes happen in the marketplace. So what we're going to do is we're going to look at how we can engage trading and use sound money management concepts to help weather the storm through losing streaks. All right, so here's a model that's 3-to-1. They were holding the trade or willing to hold the trade 3 times longer in terms of what they were willing to take as a risk or a stop. And they had a soft start here. That means they didn't go right in at 2% or the maximum risk that would be permissible. And this trader shows a regard for future losses, and I'll explain that in a minute. And the trader does drop to the lowest unit of leverage after 5 consecutive wins. Now, what does that mean? In this little spreadsheet here, this column delineates what the trade idea is going to be, and this is assuming that you get a full stop at 20 pips or full target at 60 pips. Now, obviously, these are best case scenarios and worst case scenarios. There's going to be a skew in the results, obviously, but from a practical standpoint, for illustrative purposes, we're using this as a means of providing the illustration. The set number here is how many times you have 5 winning consecutive trades. When you have 5 winning consecutive trades, as we have here, 1 winning trade, 2 winning trades, 3, 4, 5th winning trade, you have to drop down to your smallest unit of leverage. Okay, so you start with 25K or $2.50 per pip, works up to a maximum of 60K, and then after that 5 consecutive winning, he drops back down to his lowest one. By doing that, this trader is actually preparing themselves for the future loss or losing streak. So this gets back to, should the trader always push their edge? No, because you will always push yourself right into drawdown. And most traders, not everyone, but most traders have an issue with drawdown. They will lose their mind as soon as they start suffering drawdown or a series of losing trades. They start panicking, they start freaking out. And what's even more amusing is they feel these symptoms in a demo account, which is it's odd, but it's true. So maybe some of you have experienced that. You want control, and you can't control price. As soon as you put the order in, whether it's a demo or a live account, you've submitted to the marketplace, whether you like to admit that or not, and the market's going to do what it's going to do, and you have absolutely no control over it whatsoever. Your control is limited to what you have in terms of where your stop loss is or how long you stay in the trade without being stopped. That's it. So we can control the things that are directly related to us, but we can't control price. So we have to have some kind of a shield. So my threshold is 5 winning trades. So I have a beginning unit leverage of, well, it's not 25K, but for the sake of argument, we'll just say it's 25K. That's my lowest starting point, okay, $2.50 per pip. And I'm going to stay with that okay, until I can get above my equity starting point, which happens here. Beginning balance is 5,000. When it gets back above 5,000, then I can start jumping. I'll go up to the next unit leverage, which is doubling to 25K to 50K. So now it's $5 per pip I'm risking. And if this is a winning trade, I can start now utilizing the 2% rule as a maximum leverage. So 2% of 53.50 brings us to 53K or $5.30 per pip. If 60 pips is hauled off that trade, that's $318. And this would go on. I would keep adding all the way up to the 5th trade. At that moment, if I take a win on this trade, my next trade does not go 2% of this equity balance. It drops back down to 25K. And then, this is what it's meant to do, and eventually you're going to get a losing trade. And now you don't have as much leverage on there. And what that does is it flatlines your equity drawdown. See, in here we have initial drawdown, but we are starting with our lowest level of our leverage unit. Now we can go lower than this, but I'm just using this as this model. The lowest one we'll go to is 25K, and we'll stay there until we can come out of that drawdown. This period here is this drawdown here. Very modest, very low. Then it comes out. We have some growth, which is seen through here. But the 5th trade, it's a winner. I want to be getting out of that cycle and preparing for a measure of drawdown or a potential losing trade. The worst thing you can do is keep building up your leverage and risking the trade and then taking that biggest loss, because your biggest loss is going to come. So I plan and schedule, and if you want to call it this, I forecast the next losing series of trades. And to help weather that, I build in 5 winning trades. Once I have 5 winning trades, I cannot up my leverage. I have to drop back down to my lowest one. And what that does is it will plateau the drawdown. So I'll go up, get equity growth, and then I know what's coming. And if I don't get a loss, it doesn't matter, because it's still not going to show a whole lot of movement in here. And it creates a real nice stair-stepping approach to my equity curve. I don't see a whole lot of peaks and valleys. I don't see, the ski slope or the landslide, if you will, that sometimes plagues traders' equity curves. What I do is I want to protect what's been made in terms of gains, and there's no better feeling or empowerment knowing that by doing something like this, it's such a simple thing, but it takes discipline to do it. See, it feels good when you're making money, you're trading, and it's in that little voice in your head's going to say, keep pushing it, keep pushing your edge, up your leverage, you're on a hot streak. And usually about then, that's when your losing trades are going to come, and they don't come just singular, they'll come in a wave. And if you don't compensate for that, you can go through a large degree of drawdown, and that's nothing fun about that at all. So with this approach, contrasting with the previous trader, the drawdown is less with this trader because they have 5 winning trades and they cut their leverage to the lowest unit of leverage to anticipate future losing trades. Results in $346 more of preserved gains. So there's a benefit, even though we've used random numbers here, the benefit is the equity curve is preserved and it's starting to plateau versus going up and then starting to go back down. That's what you don't want to do. You want to control how much it drops. The best way you can do that is forecast and schedule drawdown. You don't know when they're coming, just like you don't know when the next winning trade is either. But we can plan for and weather drawdown or losing streaks by doing this. Now, if there ever is a losing trade, the equity is protected also by dropping down to the lowest increment or unit of leverage. Okay, so here is another model where the trader starts with 25K. So it's a modest start because it starts at 25K winner. The next trade goes to 50K. Then from there, a standard 2% risk model is used on the equity. And 3-to-1 reward risk is the idea behind this. The trader is willing to hold for moves that are 3 times what the initial stop loss is. And this trader shows a regard for losing streaks. And what that means is when the trader has been making money and takes a loss here, that trader drops down to its lowest leverage unit, 25K. Happens to be a winner, so he bumps up to the next one, 50K. Takes a loss, it has to drop back down to the lowest one and stays there, okay, until he gets a win right here. Now, as long as he's above his beginning balance, he can ante up to 50K. If he was below 5,000 in here, he'd have to stay at 25K until he got above $5,000 or whatever the equity balance starts with. Here, winning trade takes him to 50K and standard 2% rule applies. And then a losing trade comes, then drops back down to 25K, which is the lowest unit of leverage. And the same procedure starts again, 2% model after 50K leverage is used, and you keep doing that. Now, what happens here on the 5th winning trade, because you have 1, 2, 3, 4, 5 winning trades, the very next trade, he's not going to, or she's not going to, use this type of leverage here or higher. They'll drop back down to 25K because there's been 5 consecutive winning trades, and you're on an equity high here. So you want to plan for drawdown. So you get a wave of wins, plan for a drawdown. A wave of wins, plan for drawdown. A wave of wins, and now you're on an equity high. If you've ever studied your equity curve, whenever it looks like this is where you want to send it on Twitter. Okay, this is where you want to put it on Facebook because it looks great. And it's almost like magic. As soon as you do that, you know what happens. Boom. If you don't know what you're doing, the equity just falls off a cliff. Okay, so the way we avoid that and control it is I've built in procedures where after 5 winning trades, okay, that completes a complete win set cycle for me. Okay, so the win set cycle, once this goes through 5 wins, okay, then I would be on cycle or set number 2. Okay, but win sets are what we have here in individual trades that are consecutive. A winning trade, that's 1. A second winning trade, that's 2, 3, 4, 5. On the 5th one, drop back to the lowest increment unit for leverage. Okay, and you're going to determine what those are. I don't want to give you anything here except for just stimulate the ideas. You can use these as general rules of thumb and play with them, see what you get in terms of results. We're going to look at some things that help build a management model that'll help with this equity curve idea. And also I'll give you some examples of how you can accelerate it and still keep drawdown at a minimum. All right, so this is an example of what not to do. Okay, and we're going to see the effects of using a trading approach that either is by way of a new trader seeing very marginal gains and being excited or scared to hold on to it and closing at 20 pips, but willing to suffer as much as 40 pips per trade. So we have a reversal, if you will, of the reward to risk. They're only allowing themselves to make 20 pips, but holding on to losers much longer than they should, and they're averaging around 40 pips. So with a 1 to 2 reward to risk model and 20 to 40 pips respectively, this trader is using 2% risk. But look what happens. With this approach, we can see that the drawdown takes us below the starting equity. So we have starting equity drawdown, which is never fun. It's not that bad when you're losing open paper profits, in other words, profits that you have not taken home and paid income tax on. Those are a little bit easier to take a drawdown on. It's not fun, but it's better to take those than it is losing what you put into the marketplace yourself. So we suffer starting equity drawdown at this point here and goes down to the degree of 6.7% of starting equity. So this is not fun. We don't want to see this. So seeing drawdown below the starting equity balance, not good. So we're going to look at how we could use a money management approach using this reversed reward to risk model. So in other words, we're only allowing ourselves to make 20 pips, but suffering a loss of 40 pips we're going to see the effects of doing something like that next. Again, risk is twice the potential reward here. You want to avoid this. Okay, so now we have a model using the money management approach. You see, same losses in the same location, using 20 pips as their gain and 40 pips they're assuming in terms of drawdown or being stopped out at 40 pips. When the trader takes a loss, it drops down to its lowest leverage unit, which is 5K. Then 5K drops down to 10, moves up to 10K after a win. Then another loss comes, and then it drops down to 5K and stays there for every loss when it makes money, but we're below the equity balance beginning point, which is $5,000. So they have to stay at their lowest unit. Once we get back to the 5,000, then we can start adding, and then we go to 15K, which is $1.50 per pip. A loss is suffered. They move right back down to the lowest leverage unit, which is 5K, and we have a series of winning trades. After this 5 winning trades, they would have to go back down to the 5K again to lock in or preserve the gained equity, which isn't much. It's only $116 from starting equity. But you have to do these types of things to keep your open profits in your account, basically. You don't want to allow the drawdown to erode those profits. Now, looking at this, you can see the effects of it is marginal, because the improvement is not that appealing. Even though we were able to get back above the $5,000 starting balance, we dipped down below it twice, and then we see this. So even with this drawdown being recouped, this is not encouraging at all, because you're still using a model that is going to make it difficult for the effects of sound money management to do its magic. Okay, so now we're looking at a model where the trader has a 1-to-1 reward risk model. So that means the trader is going to be taking 20 pips for 20 pips risk and 2% risk, and no money management is applied here. Okay, so when a loss is suffered, as we see here, we have a series of losses. This trader sticks to the 2% rule. Whatever the previous ending balance is, 2% of that, divide that by 20 pips. That's the leverage they'll use. And 5 losing trades in a row, nothing changed in terms of money management. It just stayed at a static 2%. Not good. You can see that we had the initial run up, and then we had a nice drop down, okay, eroding all those gains, and now we're below starting equity balance. Okay, so we have now starting balance drawdown. Not fun. Even though it comes out and has a gain of 12%, this to me is still not good, because we're not handling the losses. We're not dealing with that. So we don't know if this losing streak is going to end at 5 losing trades. It could continue on to 8, maybe even 12. And who knows the emotional impact and psychological impact of losing trade after trade after trade on this particular trader. It may cause them to go in and over leverage even more, or take trades that are not as valid based on their rules or procedures. So we don't want to go below that opening equity balance. If we can avoid it, that's what we're going to try to do. And now we're going to take a look at this same model here, using reward to risk being equal. Again, 2% risk. Leverage is never cut to flatline the drawdown on this example. But now we're going to take a look at another trader. Same scenario, same losing trades, exactly where they would be. But this time, the trader goes from using 2% risk. We take a loss, they drop down to 10K or $1 per pip. That's their low end, lowest leverage unit. So they have a winning trade. They go up 1 leverage unit to 20K or $2 per pip. They suffer a loss. They drop back down to 10K, which is their lowest leverage unit. And they stay there for every losing trade. And then they make a profit. Then they can start bumping up because they're above the beginning equity balance of $5,000, which is what we started with on this particular case study. Then when there's a losing trade here, they drop back down to 10K, $1 per pip, and they have 5 winning trades. The next trade that is not in this list, they would trade back at 1 mini, which is 10K. or $1 per pip. And they would start building that model again. Look at the difference between this equity curve, even though it was relatively the same ending balance, but the drawdown, we never went below the beginning equity balance. We stayed above it the entire time. The reward to risk is again equal with 2% risk. The leverage is cut to flatline the drawdown in this example here. And let's take a look at contrasting opinion, because the results are less drawdown and more equity. Not by much, but it's a little bit more. But let's look at it side by side. Which one of these equity curves would you rather have? The one on the left is without money management, and the one on the right is with money management. So we see a much more severe decline, and we go below with what we started with, the $5,000. So we had increase in equity, same degree, but then the severe drawdown that was seen by sticking with just a standard 2% risk, expecting every trade to be a winner, like a novice trader or a gambler will. They're always holding out for that next series of winning streak trades. A sound money manager with their equity, they will see the loss and adjust it quickly, keep losses at a minimum. And then when we start making money, then we can start increasing the leverage. We take a loss, we keep leverage low again until we take a win, and we can start ramping it up again. But we stop at 5 winning trades. Now, you can increase this to, say, 7 or 10 winning trades, where it'll really allow your account to grow. But you still have to be aggressive about when you take that losing trade. You have to go back down to your lowest leverage unit. So all of these things are customizable. But I want to take a look at another example where we can show the benefits of using this with really good opportunities. Okay, so we have a opportunity of using 3-to-1 reward the risk. And we started with $5,000, and this is a beautiful equity curve here. This is what 3-to-1 reward risk and flatlining drawdown looks like after taking a loss and using a soft start. So what do we mean by that? Well, we have $5,000, but we're starting with 50 cents per pip, then going to $1 per pip, then $1.50 per pip, then back down after we take a loss to 50 cents per pip, then up to $1, up to $1.50, then we take a loss, back down to 50 cents, up to $1, up to $1.50, up to $2 per pip, up to $2.50 per pip, and then we're at 5 winning trades, so we have to drop back down to 50 cents per pip. We take a loss, not a big deal. We take another loss, it's not a big deal. We take a win, now we can start adding back, building it up, and then we take a loss at $1.50 per pip. We drop back down to our lowest end, and look at the benefits of that. Now, granted, we're not making a ton of money here. Okay, it's not a huge astronomical amount of money. Okay, but so you had 13 winning trades out of 20, with losing trades sprinkled in there in a random location, just to show the effects of what it would look like, but still having a series of 5 winning trades in a row. So you can have a win set cycle of 5 winning trades, so you can see the benefits of it. And then when taking a loss, we drop down to the lowest leverage unit. The equity curve is stunning. This is beautiful. Now, if a trader uses this type of model, 3-to-1, allowing their trade to be 3 times what they're willing to take as a loss, okay? In other words, they have a limited amount of pips. They will not let it go beyond 20 pips. So the model is 20 pips risked, and we're aiming for 60 pips. As a day trader, you can do this a couple times a week. Now, not every day, but you can do it a couple times a week. So if you figure out how many times you could realistically do that per week, let's just say you could do it 2 times a week. That means about approximately 10 weeks you could see a 12% gain on your account. I think that's reasonable. I don't think it's astronomical or too high end of an objective or a goal. But if you're a developing trader, there's certainly nothing wrong with this. Now we're going to take a look at something that you can do. This is a model that shows same starting balance of $5,000. We're going to be using a slightly different approach here. The reward model is 3-to-1. The leverage is still 2% with an aggressive start. That means we're starting right at 2% of equity on our first trade. And after 5 consecutive wins, our leverage is to be cut to our lowest leverage unit. And we can see that here we have 5 winning trades. Then we drop back down to the beginning of 50K, or basically $5 per pip. And we take a loss there. It's not a big deal. Another loss, not a big deal. We have a win. So now we can start adding up to 2% again. So we drop down after 5 winning trades. And here's the thing. If we take a single loss, we do not cut our leverage. We're allowing for that 2% rule to be there. You'll see a little bit more drawdown sometimes on this model here, but the benefits are you'll let your growth in these 5 winning trades, this is where you'll gain a lot of ground. Okay, so when this 5 winning set of profitable trades come, it really accelerates and takes you high. But you can change this and you can tailor this yourself to whatever appetite of risk you want to assume. This is obviously a contest type model where you're willing to take a loss once in a while if you have a really good high hit rate for what you're trading. If you're if you're a day trader and you know what you're looking for, it doesn't mean you're always right. As a day trader, I'm more apt to be accurate in that model versus say like I'm trading on a long-term position or a swing trade. I might have to get in that entry point another time. I may get stopped out, or I may not be able to get the leverage I wanted to put on because it had already moved and it's changed my risk to reward model when I first started looking for it. It's changed now, it's skewed and it's a little bit less favorable. So to me, day trading it's perfect. And scalping can be done too. If we use the model of, say, we do a 10 pip stop with a 30 pip objective intraday, you can find one of those every single trading day if you know what you're looking for and you have the experience. So this same model here, even though we're using 20 pips at risk and 60 pips as a gain, that 3-to-1 model can still be applied to scalping with 10 pip stops and 30 pip objectives. And you would still get similar results like here using the same money management approach.